It's my favorite move of the day or whatever. When these experts execute a downgrade and price hike, but sure, there was a downgrade to hold. Patrick Kamal of EB stating that the shares are priced fairly now. Good. Huge step up. DC, we downgrade to neutral because we believe the recent strong share performance fully reflects the strong demand response seen after price cuts, as well as a solid executive in 2024. I mean, the Q2 numbers kind of took a hit there, concerns about margins, but they delivered on Q2. The deliveries in the kind of the bold case is possibly intact for through 2024 is part of the reasoning. About a week after the company released its second quarter earnings results, UBS downgraded Tesla to neutral and stated that a lot of good news is already priced into the stock based on its near $1 trillion valuation and scorching 100% year-to-date rally, while Tesla beat profit and revenue estimates. This move was made regarding Tesla stock ahead of the company's big Cybertruck production ramp. Despite the downgrading, its decline in automotive gross margin has contributed to a more than 10 stock sell-off. We continue to see Tesla leading the world in the race for affordable electric and autonomous mobility, but on a one-year view, risk-reward appears balanced. UBS raised its 12-month price target for Tesla from $220 to $270, reflecting a potential upside of about 3% from current levels. The new target is also 10.7% above the average target of the 46 analysts surveyed by FactSet of 244.20. Though UBS advised investors to avoid buying, stating that the price already reflects strong demand, the harm had already been done, according to UBS. Tesla stock quickly began to decline after UBS analyst Patrick Hummel downgraded his rating on the company's shares to neutral after having been at buy for the previous 13 months. Back in early trading, Tesla stock dropped 5, putting the company on course for a fourth consecutive loss since closing at a 10-month high of $293.34 on July 18. The stock of the massive electric vehicle company has decreased by 11.8%, which many on Wall Street believe validates a correction. According to Hummel, Tesla is still the undisputed leader in EV technology scale and cost in the world, with unmatched software capabilities. However, for the next 12 months, we believe there is very little upside risk to consensus earnings due to significant volumes from new products such as the Cybertruck and the affordable model, which won't launch until the second half of 2024 and may initially have an impact on margin diluting. According to Hummel, he still views autonomy as a multi-year process that will only pay off financially after complete autonomy is attained. Although Tesla doesn't exactly trade on fundamentals, two more major Wall Street banks downgraded Tesla stock shortly after UBS did. Barclays analyst Dan Levy downgraded Tesla shares to equal weight from overweight, claiming that the recent rally ignored near-term questions about the stock's fundamental. Despite the correction, Tesla stock is still up 110 year to date, which is good news for investors. Levy raised several intriguing points on the position of Tesla stock in relation to the previous month. We think that the market's current AI-driven theme trade and the excitement surrounding recent plans to extend the Tesla supercharger network to other brands are the best explanations for the stock's recent gain. Levy stated in his note that even while the stock's participation in the rebound isn't surprising, it would be wise to take a step back. Levy's primary argument for the downgrade is based on three key ideas. Perhaps the AI effect is exaggerated. In July, Morgan Stanley reduced Tesla to equal weight from overweight with a price target of $250 from $200. This was in response to the company's recent supercharger partnerships, some benefits, and most importantly, how multiple expansion is actually the entirety of the rally, marking the third downgrading of Tesla. We're attempting to end the Tesla rally. According to Morgan Stanley analyst Adam Jonas, we continue to find a significant degree of investor skepticism around the name. According to Jonas, despite the downgrade, Morgan Stanley still believes that Tesla is an industrial standard and an essential addition to any EV portfolio. Notwithstanding the recent upswing, we anticipate materially lower revisions to the consensus earnings estimates for Tesla, a proponent of electric transportation and the renewable energy economy. Jonas informed investors, according to Morgan Stanley, there are increasing risks associated with testing due to the increased rivalry from China's EV competitors and the weakening customer demand for automobiles. Tesla shares one of the most outspoken experts. Jonas believes that during the next 12 months, Tesla stock will touch 450 in a bull situation and 90 in a bear case. Following the trend, Goldman analyst Mark Delaney took Tesla shares down a peg and downgraded the stock to neutral from buy. But in an unusual move, Tesla bulls on the street are now retreating to the sidelines after a massive rally in Tesla shares pushed valuation to fair levels. Wall Street analysts noted that the surge in Tesla stock was caused by the ongoing AI frenzy. After more than doubling this year, Delaney increased his price target for the stock from $185 to $248 and advised investors to increase their exposure to Tesla. The downgrade is essentially a valuation call. And the main reason for the change, in our opinion, is that we believe the market is now giving the stock more credit for its legitimate long-term opportunities. Great. We also recognize that the challenging new car pricing environment will likely continue to have an impact on Tesla's automotive non-GAAP gross margin this year, Delaney said. Delaney and the Goldman team provide several explanations for the current spike in prices, and the firm stated that the DZ Bank double also lowered Tesla shares to a sell recommendation from its previous buy rating with a price of $210, exceeding our expectations in terms of magnitude. All things considered, Tesla is still a major participant in the electric vehicle market, providing investors with positive cash debt balance and steady growth outweigh its high return potential. But around 20 analysts have lowered their profits projections for the company, pointing out short-term dangers. Additionally, Tesla's volatile stock and expensive earnings ratio without dividend payments are significant drawbacks. Nonetheless, there are a number of benefits that investors are ready to overlook the drawbacks for. Among other reasons, Tesla is going to be the pricing winner. By 2040, EV sales are predicted by wars analysts at Goldman Sachs to account for an astounding 61% of all automobile sales worldwide. For Tesla, this megatrend represents a chance to dominate the market, and the company is acting appropriately to maintain its lead over rivals, many of whom are suffering financial losses. Wars will make sure they don't impede Tesla's progress. The management of Tesla wants to lower the cost of next-generation automobiles by maximizing manufacturing efficiencies. In other words, the war has only just begun. On Tesla's 2023 Investor Day, the company's energy sector is another significant asset. Executives from Tesla outlined their company's vision to become more than just an automaker. A large portion of the presentation was devoted to grand objectives such as removing fossil fuels from the electrical grid, electrifying non-traditional vehicles, and creating more effective systems for energy storage and transfer. However, Tesla is not just talking the talk. In Q4 2022, the company's energy generation and storage business saw revenue soars by $90 to $1.03 billion, far above the automotive industry's 35% growth rate. Sales of Tesla Powerwalls and Mega Packs, which are intended to store solar energy for homes and minimize business expenses, are booming. The dependency on the power infrastructure energy is still a very small portion of Tesla's business, but it is growing quickly and has the potential to become a significant source of revenue and diversification for the company in the long run, thanks to its stellar growth rate. Tesla anticipates that demand will remain strong, so it is increasing production at its dedicated battery pack factory in California. Something else, because Tesla's historically outrageous stock price has frequently overshadowed its excellent fundamentals, investors have historically had to choose between company quality and valuation. However, as of late 2020, the company's price-to-earnings ratio soared as high as 1120, and its market capitalization exceeded the value of the 5 next largest automakers combined. This indicates that Tesla's valuation is finally reasonable. The good news is that despite the stock's P of 48 being more than twice that of the NASDAQ composite, Tesla's period of overvaluation appears to be ending. Long-term investors still have the chance to wager on Tesla's continued success, given its strong economic moat against industry competition and its rapid growth rate. However, many believe that Tesla stock is volatile, which could deter potential investors, particularly those seeking short-term investments. For this reason, experts, the main argument put up by Tesla bulls is that investing in Tesla stock is a long-term strategy that will yield significant returns over time rather than short-term gains. This is one factor to take into account when purchasing shares in the top 3 EV firms. To receive more, subscribe